Welcome to another episode of Blockrevision. Today we are recording offline, so the chat will be turned off, but hopefully the episode will be very interesting to you. So without any further ado, let's begin. Alright, and let's head to economy view. At first, what we have is a recent Fed's Bullard, that is a Fed's member of FOMC that has a much more hawkish view than the rest of the staff. That's well, what you can find is that only one more hawkish is Mr. Waller. And Bullard on Monday reiterated his view that Fed will need to get to the 5 to 7% range to meet the goal. So Bullard was one of the most hawkish members that were speaking regarding his economy outlook. So right now, what we had on the markets were kind of a sell-off yesterday, where we had oil tumbling also due to COVID protests in China, and also Nasdaq 100 that also has slided. So we are in this kind of a hesitation moment where we are still awaiting Wednesday's Jeremy Powell speech that will tell us a bit more about his viewpoint on the economy. By now, the majority of Fed's staff was more hawkish, and those hawkish views are expected to remain for longer. But this Fed's Bullard view was a cold shower for the markets. So if we just find out right here, Bullard is not a voter in 2023 and a year after. That is why his viewpoints might get a bit over the top, as he wouldn't really walk his talk and take the responsibility for his words. So that's exactly what I need to approach. That's only one dead hawk, that size of hawk that has spooked the market, and that might be just a transitory fear that may get been blown out after Wednesday's reassurance of Jeremy Powell that they may consider slowing their pace. So the US economy, what also Bullard added, that is that labor markets continue to be extremely strong. I don't totally agree with that, as the US economy added a stronger than expected 261k jobs in October of 2022, but even if that was above market forecasts of 200, that was the weakest reading since December of 2020. So figures of job market continuing to point a strong, albeit slowing labor market, is absolutely getting more visible as workers shortages right now persist. So I wouldn't really bother this Fed's Bullard raise view and rather stick to the previous projections of 0.5 hike in December. Right now, let's jump to recent balance sheet trends, and that's the one that also is worth pondering. Total assets of Fed has shrinked. That dropped by another 4.2 billion in the past week to that levels that's around 8.6 as I remember correctly, still equal to around 1/3 of US GDP. So Fed is shrinking its balance sheet by, as they foretold, 95 billion a month, and that may cause further havoc in the economy. Liquidity, as we know, drives returns. So if you just hold on here for a second, we would know that broad money flows are important indicator of where the markets will go, up or down. So if we have this balance sheet reduction as well with interest rates hiking, we would need the total sum of the shrink of the economy even bigger. So it's very hard to explicitly say how the QT relates to already interest rate hike level, but we may assume that it's another up to 3% due to economists' researchers, that up to 3% of hike for the markets, and still, if we just get to the reminder that that shrink pace should remain for at least half 2023 or even by the end and the beginning of 2024, depending on economy condition. Okay, so that was Fed. Right now let's have a look at next data. Sorry, my microphone has had some jolts, but we are getting back. Okay, annual growth rate of US leading economic index became more negative in October. So the question was how during this turn of events is performing the economy. So we have much more positivity on the market. And we had very strong rebound out of its recent support on Nasdaq, and we are right now maintaining that we are slowing down inflation. So we had strike of different gauges that were reassuring us that we are eventually lowering the tendency of that high high interest rate period in the economy. So LEI is the one that consists of many debt components regarding the housing market, and as well with some sentiment measures around PMIs, and also how the elements add up that are finding out what will happen within next few months. So we have aggregation of very particularly composed elements, and that is the outcome. This line is the outcome. Right now we are in a contraction phase, what we can assure for real, but that's the one for October. We still haven't got the one for the November, so I will get you updated. So we are jumping to next slide. Recession is not inevitable by Goldman Sachs. Is it true? Let's find out. So lower data on October's inflation poured a lot of hope into the hearts of investors, that's for sure. Although inflation is still quite high, there are more and more voices on the market that it will approach 2% at the end of 2023. So that's very, very optimistic. This is facilitated by normalization on the supply side and falling oil prices. Of course, markets assume that will translate into looser policy from the FOMC. So that's quite optimistic. Literally in the history, back in the cases with very high interest rates and very high inflation, we had that normalization within not quicker than 3 to 5 years. So when the inflation is up around 10%, it's not quicker definitely than 5 years. So within US, I would expect this one to extinguish between 24 and 25, but we will find out how that will get. It will be incredibly painful for the markets if we just get that money off the table just to shrink the balance sheets and to lower the inflation, but we don't want a deep recession. We don't want to break the system to that extent that we will sacrifice everything. So I would expect this one to persist for longer, but definitely we don't expect, at least for now, 5 to 7% of interest rate, as Bullard said. Too early to say. It's too early to say, as what I wanted to introduce is that inflation doesn't fall to what will happen if inflation won't fall to 2% and the Fed doesn't withdraw from its hawkish policy. Powell points to such a scenario for now, suggesting fears of a repeat of 1970s. It's worth noting that so far the decline in the commodity price index is much smaller than it was back in 1970s. And regarding this, we have still much more concern by far. And it's also good to remember that throughout 2001, the Fed cut interest rates from January to December. They fell from 6.5 to 1.75%, and despite this, the market continued to fall during this time. So it's not one-to-one correlation that markets are rising or falling during particular conditions, but it's about investors' perception on the case. So right now we are aiming at slowing this hike interest rates. The market is betting that will happen. That's why we can find that's rebound on the markets. But if the investors' perception will change, the market may behave in reverse. So you cannot make automation out of it. So track the perception of investors and place yourself accordingly on the market, of course. Okay, we have crypto outlook, and that's another casualty of FTX. Crypto under BlockFi has filed for bankruptcy. We are literally waiting for this, as BlockFi had many problems with maintaining their reserves. Was one of the bigger entity relying on FTX, and that's what happened. BlockFi had to file for Chapter 11 bankruptcy protection, and the latest industry casualty is this company, and that may still not be the last one. So we are kind of very carefully awaiting for the turn of events, and I would expect that some of the minor or major companies may still have serious issues, but it may take longer. Just look at BlockFi. It has filed bankruptcy after weeks or even months of struggle. Okay, market movers. So we are jumping right now to next window. So we had on Tuesday, on Monday, it wasn't much of a important elements. Right now, let's have a look at Tuesday. And on Tuesday, we had already some data out of the EU and from Switzerland that shows up that GDP growth rate is lower than forecasted. So also even this neutral politically and geopolitically territory is, I would say, prone to and vulnerable to problems from a broader standpoint. So we are waiting for data out of them. In Canada, that's also GDP yet to be published, and tomorrow the most important that may shock the markets for some extent is Fed Chair Powell's speech right after job openings report. So that's it out of this issue. Right now, let's jump back to our slides. It's trade idea, the last section for today. So we are heading back to our search engine, and let's get back to my proposition for today. That's a silver. Silver is in a very nice spot right now. We can find it. We have broke out of this consolidation that lasted throughout a few months, and on November it shows some signs of recovery. So we are forming kind of a pennant pattern that is a continuation pattern after the impulse that was brought to us in the first half of November, and during consolidation at this area, we can find that there is a high possibility of getting back to the area of next resistance. That will be next checkpoint to mark off. So in terms of trading idea, I do expect that silver will rise by that amount of from here 15%. So it's quite lucrative regarding even small leverage. But even if you don't wanna use leverage, that also will be quite decent gain. In terms of risk reward ratio, right now it's at 3.4 regarding the area I've appointed. But if you wanna increase your odd of gain, I would expect XAG to backtrack to this lower boundary of the pennant. This pennant may morph to some extent, as it's quite a young formation that have been just formed within 2 weeks. So it may remove further, but I would expect it won't drop below this this hammer that was constructed on at 21st of November. So that's my proposition for today. Regarding the area of an entrance, I would expect this one has been still fine within formation. But if you wanna have more clarity, wait for the validation of the formation and also the breakout out of the triangle. Right now, I would take my position within a triangle, as it's a pennant formation, so I may wait some time, but I would expect this to break out within hours or days. So that's it in today's episode. Thank you very much for watching, and excuse my offline version of transmission today. Tomorrow we are getting back. As always, hopefully there will be a live, so you will get the option of attaching comments on the chat in a live option. Otherwise, there will be a chat below the video, so you will have the chance anyway. So thank you once again, and see you tomorrow.